Welcome to the Propenomix podcast with Adam Lawrence, where property, economics and business advice mix to help you achieve better returns.
Good morning, beautiful people of the internet, and welcome once more to the Sunday special. We are live, as always, with the beautiful Helen, Chorley, the enigmatic Adam Lawrence, the superstar legend that is Piotr, and myself, the ever humble Jay Howard. And I've just finished reading the supplement. Who else has finished reading the supplement? Okay, yeah, I thought maybe there's a bigger reaction of folks online watching going, I just read it, I'm about to leave a brilliant comment. Blah, blah, blah. So, yeah. What has everyone been up to? What's the story for the day?
I did just do a 4.5k walk. Boom, and I hate walking. So Can we have that? That's an achievement for the day.
Definitely.
Nice. Adam, you've done your 4.5k?
I've done my 4.5 minutes. I don't think I can do a kilometre a minute. Is that acceptable? I prefer high intensity because I'm impatient, Jay. What can I say?
It's a minute and a half longer than I would go, sir. So you're doing exceptionally well.
I did 21,000 steps yesterday.
Whoa!
And I was there for about 8,000 of those.
Yeah, about 8. Yeah.
And you're claiming the other 13,000 by proxy, basically.
Of course, yeah.
I made Jay walk up the stairs, not take elevators, walk up the escalator on the underground where he would always just stand. So yeah, there was a lot of breakthroughs for Jay yesterday.
Yeah,
and he can't wait. He can't wait for you to get back to Portugal.
Yeah. Yeah, those breakthroughs were cartilages and tendons. That's what those were. I'm walking like
physical and mental. Oh, nice. Okay. So supplement.
The supplement kind of felt like a bridge over troubled waters. You know what I mean? It was kind of like you were kind of trying. It's a Simon and Garfunkel song. You were trying to get us from one side over those trouble situations to the other side. I mean, at the moment we're staying pretty close to city centre, and you can smell the trouble here. Like there is a strong kind of you can feel it. It's almost like there's an aura of something that's just trouble's about to kick off. And
interesting.
You can see that just by looking at the city.
Looking at volume of people. Do you think, or
the lack of volume of people?
Yeah.
No one's really out and about doing anything, or at least in far fewer volumes than pre-COVID.
Yeah. I think the difficulty maybe with some of that. I've just seen a headline flash up that Zahawi's been sacked, so probably not before time. I suspect. I think it's difficult because you've got the regionality / urbanisation versus deurbanisation effect, which is, I think, been quite a bit stronger than most of the CEO, board level, business owner level wanted it to be. And that's sort of ongoing to a general rule. But I mean, that wouldn't obviously affect Saturday and Sunday necessarily, although where people are living might well do. I don't know because I haven't. One of the things that surprised me probably over the last sort of 6 months maybe is the stories about rental demand have been about places where historically they wouldn't have been as desirable as, say, London or Edinburgh. So that the story about the 1,000 applicants for the flat was in Glasgow, that a few people pointed out. And a lot of these rental market pressures that we're seeing, obviously, with due respect to the areas that we invest in, they are generally speaking slightly higher yielding and therefore slightly more blue collar / industrialised than they are service driven as a rule. And that's where the bun fights are really occurring over nearly all sorts of rental properties, really. And I think on the HMO front occurring where there are at least as many graduates and people, let's say, under 30, to draw an arbitrary line in the sand, chasing rooms as there has ever been, if not more. I mean, the HMO landlord report from within PIP is a unitary, my goodness, I've never seen it like this before, all over the place. But those would be suburban parts of Birmingham more than they would be central parts of London, or suburban parts. I mean, obviously the burbs in London, it's kind of difficult to tell the difference between. It's fairly easy to draw the line between PCL and all the rest of it, but the rest of it kind of meshes into one over a very large area, doesn't it? Really. So I don't know how much of that is still urbanisation effect versus anything else. I'm constantly surprised by the amount of people that I drove yesterday. I was in the car for about thick end of 2 hours, I would say, pretty much flitting between Solihull and Birmingham, Birmingham in a different part of Birmingham, Birmingham back to Solihull, back again, around and about. And I couldn't believe the volume of traffic that was on the road on the upside. And I couldn't believe the volume of people in retail and eating establishments. I was really surprised to see that. So I would have a very different tale on that story, but not Birmingham city centre, bear in mind, more likely, 4 or 5 miles outside of the city centre, one side or the other, seemed to be very robust. And I was surprised. And that the traffic was relatively thick last weekend, whereas the first couple of weekends of the month, it was absolutely mortal. So I think the point I made in the supplement today, I think it's definitely taken the housing market longer to restart. We've got bits and bobs still hanging around which have fallen through that we were trying to sell last year, and have been fair. I'm not saying we haven't dropped any of the prices. Some of them where we knew we were on at a punchy price, we've been willing to come down, but we've been fairly robust with what we've done. We had one fall through this week where they'd made a significantly higher offer in the first place, and then chipped it down semi-legitimately, which we kind of accepted, and we were so near the line we sort of let them off. They eventually pulled out, even though they had a very low mortgage rate. They were obviously just stupid time wasters, and I suspected half as much. It went back on and sold for £5,000 more within 24 hours.
Wow.
Now, that was in South Wales. We've got another one that's been on. It's a bit of a trappy house, really. And we're overall leaning towards divesting in South Wales, probably about half of our stock. So whilst I think that in the medium term, there'll be the pressures they're putting on the market there are as negative for the tenant and indirectly positive for the landlord as what they're doing in Scotland are at the moment. It's not, to my mind, an area of significant outperformance, which it was sort of 2016, 17, 18, 19. So I've been kind of almost looking at cashing up and reinvesting elsewhere on that front. And I do have more concerns over things like rent controls, which will be, in the medium term, again, will not help anybody apart from the landlord, but in the short term could be quite painful and damaging. I'm kind of voting with my feet in South Wales. I feel some of the legislation has been stupid, quite frankly, and will lead to cash flow situations and headache situations that we just don't want or need if we're not getting investment outperformance in that area. I suppose that's the way I'd frame it. And that we had this one trappy house that's been there, sitting there for a while. Again, that's taken an offer this week, which we were able to get up to full asking, a decent buyer. We had another one in Scotland, which has been sitting since sort of early December. Not the best time for it to go on the market, but that's where the JV partner wanted to pitch it. And that's been agreed at over asking price this week, considerably over asking price to a cash buyer. And there's a few more, I could lament a few more of them to you, things in negotiation. But the bottom line is things have really woken up this week from our own data and also from speaking to people around and about. There's a bit more robustness in that market than everybody thought. I think there was a almost semi-withdrawal around about the Kamikaze budget time, and that does seem to have repaired itself a little bit. And people are impatient, and owner-occupiers can't really wait to move if they've got the mortgage offer and they've got the deposit they want to crack on. And this is all sort of forming into my view that's been there for a couple of months now, that we could easily see quite a flat market this year, and all of these 8% down, 12% down, 15% down predictions are useful when you're negotiating, but in reality, I don't think that's what's going to play out. And a lot of that is also predicated on just how robust that inflation is, because if wages are up 5, 6 or 7 this year and prices stay the same, houses are 7% more affordable than they were on January the 1st, 23. So people need to also put that into context. I think the amount of forecasting and modelling and just overall understanding of the economy is really, I'm looking into this more and more as the weeks go on, and it's really poor in an inflationary backdrop, really, really poor. So the one thing that I would credit the government with, and I haven't been too praiseworthy of this administration in general, although it has had different forms of which I've been differingly detrimental about, is that the wage price spiral argument situation, they are handling it in the right way, in that they can't let it run away from them. But we've got to fast forward to where there are agreements made. There will be agreements made, because people won't be able, once energy price cap goes up again in April, there'll be more cost pressures for people. And there will be agreements that we have to get to that will look something like between 5 and 10%, I'd imagine. And they'll keep a lid on them for as long as they can, or kick them out for a number of years. But they are doing the right thing on that front. But once that 5 or 10% is entrenched, and the private sector spend this year trying to catch up on what's run away from them last year, then ultimately all that extra money in the pocket will allow things to rumble on, unless we get a significant reduction in demand. Now, what is quite frustrating and difficult to measure is an accurate picture of what excess demand truly is, because people have fallen into this trap of thinking, right, inflation means excess demand. Well, yes, depending on how you measure it and where you see the problem coming from. Obviously, inflation in the first place came from restricted supply. So any demand was too much demand to an extent, but it wasn't that excess demand that's historically been created as the driver behind many inflationary points in the past. So as that transitory kind of demand is supply issues have or are working their way through the system, and there will be, a China coming back on, once they've dealt with the Omicron blip in their numbers, which are really quite significant because they've got so many people apart from anything else. And that's not a tomorrow thing or a next week thing, but it's something we will observe over the course of the next few months. There will be that extra demand in the world around energy, and potentially some price pressures upwards and all the rest of it. But the excess demand that needs to be choked off by a central bank inspired demand destruction event is not really there in the first place. No. Now I'm concerned that the Bank of England are not measuring this in an accurate way, and I'm perhaps not understanding, or their models are too predicated on data from very low inflationary times to be that meaningful. And I was surprised today when I looked up, even in November 22, they're predicting unemployment at 6.5% in 2024 or early 2025. Now, they do say themselves that's predicated on them doing what the market think they're going to do in terms of interest rates, which has calmed down a fair bit since then. But it just seems such a high number from where we are today as to be meaningless without a really significant demand destruction event. The vacancies are still there at these huge levels. And I go back to the central point of the research I did around COVID. Ultimately, what you've seen after pandemics is that Labour's hand, not little L, not the big L, not the political party, Labour's hand strengthens versus capital because there are fewer workers. Historically, that's been an event because people have died and there have been fewer workers in the pool, right? This time round, not so much that, but people have voluntarily withdrawn themselves from the pool, some of them being able to use that stimulus that was provided in order to change what they're doing and take themselves out of that labour market. There's still several 100,000 people who are of working age who are not in that pool, not in that position. So all these differences and all these nuances mean that a lot of these models, I think you've got to be very cautious about. And whether I'd be right to characterise dense urban versus suburban in that example, that exchange we just had, Jay, I don't know, but I think it would be a factor. And I think, you've seen London, although prices have moved quite nicely for London investors over the past couple of years, it has been the bottom of the pile in terms of house prices driving forward. And I think at the moment, it's quite likely to stay there. And you could load some of that onto, it outperformed so much in the last decade when the rest of the country, aside from your Bristols and your Oxfords and your Cambridges, were just doing nothing at all. You could load it onto the fact that, confiscation of assets from Russian oligarchs means that any dodgy, very wealthy people from the rest of the world decide to put the money in Dubai rather than London, just as an example. There's a number of reasons behind that. I still think the robustness of the legal system sees London as a very attractive destination for money. And I think some of those foreign inflows that were at the beginning of the 2010s, there might be a bit of a pickup in that because sterling is still cheap and it might sort of chug along on that basis. But whether the suburban versus dense urban effect is so powerful at the moment that it's sort of flattening that out. Whereas in the long run, and as Keynes always said, in the long run, we're all dead. So it's such an economist's way of looking at the world. But in the long run, the tendency will still be to urbanise as a population. So I don't see London in long-term decline. I'd be very, very surprised if that was the case. But at the moment, the shorter-term forces, I think, are maybe just pulling a bit stronger than the overall trend. And it's the same for inflation. Overall, limp productivity growth, to be generous, fairly low population growth with a very aggressive Home Secretary at the moment, although she's not been able to control the numbers, and probably a significant change of tack from the Home Secretary going forward when we get a new one under whatever administration we're going to see over the next couple of years. But there's lots of reasons to be fairly bearish on inflation to the downside because there's just not a huge amount of economic growth. When the population stops growing, or when the working age population stops growing, you'll start to have more of an Italy/Japan problem, and it'll be very different. So that's the longer term backdrop. But in the short term at the moment, ultimately the pressures are there in terms of primarily wage pressures are what are going to remain behind, and that's going to see people have more money to be able to pay higher rents or pay more money for goods in the supermarket or whatever is going to be, and business will react because business is very clever at finding out what people's willingness to pay is and extracting that money from their pockets ultimately. And that's the sort of 419 as I see it. So I'm quite a bit more cheery and rosy today than some of the last few months because reality kicks in and people just carry on with carrying on. And the sword of Damocles is perhaps not as sharp as perhaps it's been made out to be by some of the forecasters.
So it is an interesting environment at the moment because you did see, especially in COVID, a lot of people kind of just London being one of the main ones. I was definitely one of those people. I was a statistic. Went from North London to Northamptonshire.
Mate, you're so much more than a statistic. Don't be so hard on yourself. But what have you guys seen from the auctions this week?
We probably not for the best. We don't really look at the January auctions.
Okay.
They tend to be kind of scattergun. It tends to be stuff that's holding over from the December auctions that didn't sell. You'll still see some of that in February. December was a bad month for everybody. It doesn't matter how they paint it. It didn't look good. Having a look at the January ones though, it's very itty bitty. There was not the kind of asset split and quality split throughout the country that you'd want to see to go, okay, well, this area is doing well, or this type of asset's doing well, or this is struggling, or this is sticking. But in the next 2 weeks, 3 weeks even, there's like 100 and something auctions, and 40 of them are big catalogues from main providers where there's going to be an asset split and a quality split nationally, where it's going to give us a far better flavour. And we'll probably try and blend the February numbers in with the last 2 weeks of January to get to kind of open that picture up. But
what are you expecting? What would you say you're expecting from what we've got over the next 2 or 3 weeks?
I think in general, like the amount of people looking at properties, for example, the ones we're selling, is like pretty encouraging. Like there is quite a bit of people looking, and we never know how this is going to translate into people actually bidding and doing things. But yeah,
well, no one in the top of the funnel is never a good thing, is it? Realistically, so some of them should filter down. So that very much sort of backs up what I was saying about the on market experience in the past 7 days. Interesting.
Good.
Yeah, we're not holding our breath for a bad market. There seems to be the right kind of noises. We got these 2 beautiful hotels in South Shields, and the extrapolated income on like an SA kind of Airbnb, Booking.com kind of thing is £120,000 per annum. Obviously, there are costs associated with that coming in, Booking.com fees and cleaning fees and everything else. But they're really very nice, and the income is super attractive. And obviously, if it's serviced accommodation, it doesn't attract the Section 24, and it's being sold fully furnished. So there will be some capital allowances sitting in there somewhere. So those are attractive little deals that seem to get quite a lot of attention. But I think people are still looking to buy income. I think in your article, you mentioned, there were a lot of developers that kind of just came out of the woodwork because it looked like there were undervalued opportunities being snapped up. And I think that's right. There's a lot of kind of commercial to residential developers coming out of the woodwork, looking at vacant commercial, which is difficult to value at the best of times, and twice as difficult to value at the worst of times. And I think they were looking at just picking up as many as they possibly could. Like a 4-year-old.
If we went back 12 months and said, let's approach this development, let's look at the sensitivity analysis. What if materials go up 5 or 10 or 15%? Most people were saying, well, hold on, what if they go up 40%? Because this is the sort of volatility that we've seen. Whereas sitting today, you probably feel a lot more confident in the older metrics, and you might be dealing with a higher cost base on the way in for sure, but the volatility is nowhere near as aggressive as it was. And that might be what we see a bit of in geopolitically. I think there's more certainty. There seems to be more certainty. A few tanks are lobbed into the mixer, but not enough tanks to make a real go of it, would be probably my summary of the last week or 10 days of all of that from what I've heard. And the tank experts that have been on the radio as I've been driving up and down the country, quite interesting stuff. And it still appears that it's unlikely that China are going to go gung-ho into Taiwan, especially as they're dealing with their sort of COVID reopening. So whilst we've seen the pot bubble, still, it might not be as volatile as it has been over the past 12 months. A starting of another significant hot war looks unlikely. And Ukraine, Russia has almost got to business as usual kind of standings, really, as terrible as it is to say that. That is the economic and political reality of it. So less volatility in terms of prices, less volatility in terms of geopolitics, less volatility in terms of interest rates, because interest rate volatility and bond volatility last year was just incredible. And you're not going to see the same again this year. And all of that leads to, again, comparatively more confidence than there was. And of course, there will be that driving force behind. We all know this. We've talked about it for the last, several years. There's lots of cash on the sidelines, and that's a really significant difference from 2008, 2009, that cash can't stay in cash forever. And if bonds haven't been a safe haven, then it wants to go somewhere. You don't know whether bonds are going. I would say we've got a longer term trend back downwards in the interest rate very slowly, but that inflation robustness is going to mean we do have ups and downs. Of course we will, but it should trade in a much narrower range in terms of the bond yields. And that does bring people back to the table for a number of investments. And when I suppose every day on the clock where the crash that the last one that the media has picked up doesn't happen is a day where people think, well, hold on a second, I'm out the market here. And that's the problem.
Yeah. I had a conversation this week with a finance guy who echoes exactly what you said. There is a lot of money sat on the sidelines. So that's exactly what he was saying. All these predictions of big or decent sized crashes. He's like, the money would come in and kind of, comes in, gets it cheap and effectively props up or limits any drops. So that's certainly what I've been hearing from. He deals with a lot of family offices. So there's clearly people positioned and just waiting.
And I think they would probably tell you, they hear about a possible recession once a year. I mean, if we just went back to 2016, Brexit was going to end the world. We're waiting on Brexit and that's going to end the world. We're still waiting on Brexit and that's the problem. Brexit's a problem. Now there's a pandemic and suddenly there's more money, loads more money out there,
Dominic.
Thanks, Tom. Yeah, agreed.
Thank Harry and Meghan for distracting property doom from newspaper headlines.
But I think, Helen, that raises another good point in that the two, we have to remember 2008-9 emanated from the financial sector, and credit to the regulators and the governments in the interim, they have shored up a lot of those. So what really kept things not too concerning last year, apart from Kamikwazi/Truss, was that the affordability, the Bank of England had kept that affordability at 5.5%, for 10 years. So all these mortgages that have been underwritten were based on the base rate or the pay rate going back to that sort of level. And only for about 4 to 6 weeks did we see the pay rate go above that. And that wrinkle will iron itself out back through the market, and perhaps is why people are back to the table today. You've got rid of nearly all of the buyers who would have secured a nice cheap interest rate if they had a decision in principle before the end of August, 2022. So that 6 months is realistically the lifespan of all of that. That takes you to the end of Feb, but it will be trailing off very insignificantly. So that's kind of worked its way through, and people have woken up to the reality that, it's always been the case that the deposit has been the blocker for the first time buyers, and the deposit remains the blocker. It's still harder to afford 50 grand deposit than it is to be able to afford pretty much what you're paying in rent every month. Even though the discount there was on owning versus renting has gone pretty much. But that wasn't the primary drive. It was a real secondary driver in that market. So it was a difference between what you wanted to do and what you were actually able to do because you'd had the money, or Bank of Mum and Dad stepped in, or however you funded the deposit, I
think that property ownership has always been quite aspirational, right? It's, your parents own the property, you want to own the property. There was a period of time, I think, like between 2014 and probably 2019, where there was a whole group of people that just thought, actually, I don't want to be tied down. I don't want to be location specific. I'd much rather be able to rent here and then maybe move there with work. And they were looking more into the fluidity of living, not a like a traveling style lifestyle where they'll be here one week and there the next, but they like the idea of you've got all these digital nomads now.
Yeah.
Not billions of them or hundreds of millions of them, but especially not in the UK. But there are UK workers that are working out of Mexico or working out of Portugal or Spain or Italy or Greece or wherever it is.
Leave Portugal alone.
Don't tell anyone about Portugal. Yeah. But the reality is that there's a lot more of that. And I think renting is still a really solid option. I think going to your point you mentioned earlier on is there's a lot of people not of retirement age that are exiting the labour market, but then you see a lot of people that are of retirement age going back into work.
Or carrying on. That's true.
Yeah, see people like 70 odd, working at McDonald's, right? Because they need that extra money. They've kind of come out. They can't. The cost of living for them essentially is a little bit too high.
Yeah. Well, it's difficult. I'm talking to a couple of friends of mine at the moment who are looking to exit their business. They're not particularly old. They want to get out because they're not enjoying what they're doing. And one of the exercises we went through this week was to check where they would be at if they did, even if they just liquidated it. Have they got enough money to survive? And what do they need? What do they want? And we had a long discussion about that sort of double bubble of also when you're out the workforce, it then means you're in consumer mode 24/7, 365. So actually something that keeps you ticking over. And one of these big, B&Q's always been a favourite, but these massive machine style companies like a McDonald's, there's also a positive way of framing that work to get out there, to see people, to do something. Yeah. And even cost of living wise, you're not heating the living room, you're not doing all of that stuff because you're out of work in a restaurant doing it, moving around, keeping yourself warm. There are some positives as well to be taken out of doing that. And people are, some of that is to do with non-forced retirement and everything that's worked its way through the system in terms of that in the past 20 years. And some of it's to do with the fact that these days, because of things like social media, you see these digital nomads or you see these people who are still working into their 80s and are very, very positive about it. And I think it empowers people to not necessarily follow anything like that traditional career path. I mean, if you went a generation or two above us, you would find that very, as a near solid rule, anyone who learned anything about finance before 1980, let's say, in that you got a job, you paid the mortgage down, you retired. That was it. And there's positives to that, but there's also negatives to that in the way you were trapped into those things. As things have been, restrictions get lifted on people, we could go full emancipation of women. I can feel Peterson. Peterson's just here. He's here. He's talking to me. We've got stuff to say. Hopefully Andrew Tate is not here, otherwise it'll go downhill very quickly. But it's society grows and it changes, doesn't it?
It's super interesting because if you went that generation above, or one or two generations above, you would find that the retired people, en masse, you'd either find them on a golf course or you'd find them doing some kind of volunteer or charity work. And I think you're actually seeing more of them re-entering the workforce, like you say, in a positive way. But I don't know when the last time in society that was becoming the norm, because there is that switch. It's just interesting more than anything.
Definitely positives and negatives of it, but like anything, life deals you a hand and you decide whether you react to it in a positive or not. No one else can really do that for you, can they? I've known many people who they could have framed their circumstances as this happened to me and that happened to me and all the rest of it. And, they're not wealthy or even not poor by any stretch of the imagination, but in their mind, they're rich. And that's the key. That's the key.
Yeah, sometimes it makes sense to fold aces.
Yeah, absolutely. On the bubble, normally, but on the bubble.
Interesting. Got a couple of comments as well, previous things. On the ground reference to amount of people in restaurants, blue water busier than usual. Yeah. And that's saying that the nephew's got a clothing shop in Birmingham, Solihull, London, and said people used to go to shops, they used to grab something to eat. Now they go to eat and maybe grab some shopping.
Interesting. And inevitably that sort of shores up the future of the high street in a way, doesn't it? In terms of, what do? You go and get stuff you can't get on Amazon, generally speaking, and you're still going to win. Shop windows will still work, and that's why probably the Costas and that of the world drive that other brands are available. Obviously, the footfall gets driven by those quirky bits that are in the walkways of shopping centres. Yeah,
indeed.
So
Wow.
we're feeling cheery. We're feeling cheery as we go into February. Although we've got a Bank of England meeting next week, so that might make everyone more miserable. It inevitably takes a further slice out of the dwindling Lawrence empire of beautifulness. And it'll be a while until that base rate's coming down, I suppose. But I'm thinking I didn't put it in the
it's like I saw headlines. I saw headlines on BBC.
Yeah.
Some the traders are expecting rates to come down. What are your thoughts on this?
Well, I think the headlines say they're expecting them to come down in early 2024. I don't think they're going to be coming down this week. This week coming, I think we're going to go. I think we'll go up another quarter, and I think we're going to have to test 4.XX. But if things are going along as they are, what you've got to bear in mind is there's this perverse inverse relationship at the moment with, while the labour market still looks good, the central bank is empowered to put the rate up even more. Because no one in the Bank of England is going to come out and say, do you know what, we're really bloody surprised at how we haven't really buggered up the economy by putting up the rates as much as we have, right? Yeah. We're really surprised. But I think if you had a DeLorean and went back and asked 100 economists on 1st of January 2022 and told them what was going to happen, 99 of them at least, including me, would have been covering the head with their hands, ready for a bomb to go off. It just hasn't really happened. So whilst things do look better, that doesn't favour those who want the rate to stop increasing. But what it will do, because remember, the bond markets are smarter than all of this. The bond markets are kind of seen most of this coming, although there were obviously that big volatility in September, October, because nobody saw that coming. Not even the people who did it saw it coming because they didn't know what they were doing. So I think we'll see. Let's not get too fixed in with base rate, and hopefully we'll see maybe bond yields just decay by 25 basis points over the course of this year. I'd be surprised if they decayed by more than 50 basis points from where they're at. But I suppose there's a chance of them decaying 50. But that means that will translate through to, with some efficiency savings, mortgage rates maybe 0.25% to 0.5% cheaper by the end of the year on 5-year fixes, which will, every little helps, put stuff back on the table. That in itself will bolster confidence. Whereas at the moment, for the last 2 months, I'd say most conversations I've been having with people have been along the lines of, well, how are you getting things to stack up these days? And there are ways and means to do that, depending on what cash you've got access to, what investor relationships you've got, what you can do with vendors. But that doesn't help you do volume. That just helps you carry on trading and do interesting and creative deals that can sometimes be very lucrative. Whereas I think that little bit of decay, I do think they'll be quite robust. I think they'll have to be, Piotr, because I think if this all comes back to my central tenet, inflation's going to hang around at the
what do you think,
4 to 5% level. It'll hang around.
What do you think of those predictions like 2 years ago, like people saying, if interest rates increase by 2%, it's going to crush the economy and stuff like that?
Well, again, I think
how do you refer to those kind of past comments?
I think they were all being done on old data, realistically, when they were done by the bigger. Whereas from people like me, who were very concerned if we went beyond that, which I think you could probably go back to. I did a video with Helen and Ruth, I think it was, wasn't it, at the beginning of 2022, where I predicted that base rate would end the year at about 1%. Couldn't have been further wrong. And I'm sure if you listen to that, I probably said if it went above that, I'd be very concerned about the health of the economy. It has played out in a much stronger and robust. The photo today with the supplement is the wounded buffalo, because that's how I see it in my mind. It's taken the poison darts, but it's just cracking on, and it's going to take a lot more to drop it.
Yeah.
Very interesting.
I think my prediction was about the same. So.
Well, to be fair, I think we also predicted Bitcoin would crash, which was spectacular and absolutely bang on. I think we predicted the S&P would go down, not up, which was spot on. There was a number of things that were positives to be taken out, but I dislike these predictions where people just sort of move on and pretend they never get anything wrong. And if anyone could be bothered, it'd make a great blog, in my opinion, if you just went through and looked at the predictions of the Bank of England and the Office for Budgetary Responsibility, because they'd never get it right, and there'd always be something to write about. They'd never get it right.
Yeah. I think it's really good to like look at things that were said like 2 years ago, because then you have the real comparison to what actually happened, and you can then predict better for the future, because you know like what you were maybe afraid of that didn't happen, or what you weren't afraid of and happened, and how you reacted to it, and how all those things kind of came together.
That's more the thing. That's more the thing, isn't it? It's what you didn't see, what you didn't anticipate happening, because by its kind of nature, you're working with historical data, and yes, you can kind of have a look forward, but nobody saw what was going to happen with exactly like the bond yields and stuff that we've talked about. Nobody could where were you going to ever pull that from?
The science of unintended consequences.
Genuine black swan, realistically, which actually was handled very, very, and I do feel for the Bank of England and the government in situations like that, because nobody ever comes out and says, actually, well fielded, really good. They just come out and say, well, they did their job there, and then if they get anything wrong, they just get crucified for it, and that is inherently unfair, because there's some exceptional economists at the Bank of England on the Monetary Policy Committee, probably the best in the world, I would say. But and it's good because they have a level of disagreement which over the past few months has actually shown itself to be there, and I hope that doesn't get ironed out of the system for political reasons over time, because that debate has been really worthwhile. And when it's come to the crunch, much as I'm not sure I respect the leadership at the moment at the very top of the bank, they've done the right things. They've done the right things. So I have a lot of faith in them.
So coming to the end of this show today, let's vote on the interest rate.
25 bits up, 0.25% up.
I was going to say that.
That's all right. You're allowed to say it. Right, alphabetical order, right?
I'm going to go up 0.25%. How about that?
Down or up, Jay? Up. Yes.
I think we have consensus.
Okay.
Like
I think there'll be a couple of votes. There'll be 2 or 3 votes to lower it, though. Probably 2.
Yeah,
probably
definitely.
2.
Yeah.
But there was some.
There was already, wasn't there? So
after the last budget, after the last committee, right? There was 1 or 2 that just kind of felt that maybe keeping it at the same level was.
They thought 3 was enough. You're right. Yeah. And I think they'll probably vote for 0.25% down, or maybe stay the same.
It will be interesting to see what's going to happen to auctions, because auctions are like the most sensitive to those things, like especially in a few days after their vote. And there's like a lot of auctions on the 6th, 7th, 8th of February. So
bring the volatility back, I say. We love a bit of volatility. Come on.
On that positive note, gonna wrap up for today. I've got a couple of meetings and I need to go, and we all need to get on with our days. So guys, thank you for tuning in, putting comments.
Thanks for the comments, everyone.
Thanks for listening to the Propenomix podcast with Adam Lawrence. To keep up to date with the ever-changing markets, please subscribe or follow me on LinkedIn, Adam G. Lawrence.